There are so many ways to invest in real estate today. I mean, everyone talks about higher home prices and interest rates, but when getting creative, you can choose an option that helps you reach your goals, no matter what the market is doing. You are only as limited in options as you are in your creativity. When comparing the different strategies of real estate investing available today, it's important to consider factors such as risk, return potential, liquidity, and management responsibilities. I've listed 7 different ways you can get into investing today, and this is just the tip of the iceberg. Direct ownership and real estate partnerships offer potential for high returns, but require significant expertise and management responsibilities. REITs and mutual funds and EFT'S offer lower potential returns, but provide greater liquidity and professional management. Crowdfunding and fix and flip investments offer high return, but carry higher risk and require specific expertise. Short-term rentals provide an opportunity for high income, but require significant management responsibilities and a dependence on the vacation rental market. Investors should consider their investment goals and their risk tolerance when choosing a real estate investment strategy. So let's spend a few minutes together and dive into the details of each of these 7 strategies. The first one is direct ownership, and it's the one I talk the most about. Direct ownership is the most traditional form of real estate investing. It involves purchasing a property outright and generating income through real estate income or appreciation of the property value over time. I mean, think of your primary home or a long-term buy and hold property. This type of investment can require more time and effort, but it can be done by yourself. No need to pay a third party, and it offers the potential for high long-term returns. Some of the advantages include potential for high returns through rental income and property appreciation, control over the property and the investment decisions, they're all yours, and potential tax benefits such as deductions for mortgage interest, property taxes, and depreciation. Now, the disadvantages are it's all you. The maintenance, finding tenants, and handling repairs or turnover, yep, that's on you. Risk of vacancies and property damage need to be covered. And if it's your primary, really the only risk to you losing money long term is if you lose your job and have to sell quickly. The second one is real estate investment trusts, or REITs. I have several of those personally. REITs are publicly traded companies that own and manage income-producing properties. Investors can purchase shares of a REIT and earn income from dividends or appreciation of the stock price. REITs provide a way for investors to invest in real estate without the high costs or responsibilities of direct ownership. Some of the advantages include access to a diversified portfolio of real estate properties, whether it's out of state or the type of property. Liquid investment that can be easily bought and sold. Now, some REITs will require that you hold them for a period of time, and some have more flexibility. They also have professional management of the properties. It's nothing that you would need to do. Now, some of the disadvantages include a possible lower potential for returns compared to a direct ownership. A lack of control over investment decisions. It's not yours. You're buying into a portfolio. And then the dependence on the performance of that share value of the management or that local real estate market. Before we move on to number 3, if you find this information helpful, make sure to give the video a thumbs up and subscribe. It really helps us to get the message out there about how real estate truly is the most accessible way to build wealth. On to number 3, real estate crowdfunding. This has been getting a lot of playtime lately as Jeff Bezos has rolled out his own crowdfunding platform. So real estate crowdfunding involves pooling funds with other investors to invest in typically a specific real estate project or could be a portfolio of properties. Crowdfunding platforms connect investors with developers or operators who need funding. This type of investment allows investors to participate in real estate deals with smaller amounts of capital. Some of the advantages are access to a range of real estate projects with lower investment minimums, diversification across multiple properties and locations, and professional management of those properties is built in. Some of the disadvantages: limited liquidity and the ability to sell investments quickly. Typically, you can't just get out when you want. Higher fees compared to other investment options. And again, limited control over the investment decisions. They're not yours. Number 4, real estate mutual funds and EFTs. Real estate mutual funds and EFTs invest in publicly traded companies that own or operate real estate properties. Investors can purchase shares in these funds and earn income from dividends and/or appreciation of the fund's value. This type of investment provides exposure to real estate markets with lower costs and higher liquidity than direct ownership. Advantages of this type of investment include diversification across multiple real estate companies and properties, lower costs compared to direct ownership, and of course, professional management of those investments. Again, the disadvantages: dependence on the performance of the stock market. Remember, you're buying shares of these companies, limited control over the investment decisions, and lower potential for returns compared to direct ownership. Number 5, real estate partnerships. Real estate partnerships involve partnering with other investors to purchase and manage a property or portfolio of properties. Investors can provide funding and/or management expertise in exchange for a share of the profits. This type of investment allows investors to share the costs and the risks of real estate ownership. Some of the advantages include access to larger and more profitable real estate deals, getting into bigger deals than you might be able to yourself, the ability to share costs and risks with other investors, and the potential for high returns through rental income and property appreciation. Disadvantages: limited control over the investment decisions. You're sharing that decision with a partner. The risk of disagreements among partners, and the dependence on the expertise and the management skills of those partners specifically. Number 6, fix and flip investments. We continue to see a lot of these, even with purchase prices going up, because of the opportunity and the desire for buyers to buy a perfect home. So fix and flip investments involve purchasing distressed properties, renovating them, and then selling them for a profit. This type of investment requires expertise in property renovation and market analysis. An advantage of this is the potential for high profits in a short amount of time. Yet the disadvantage is the high risk due to market volatility and the unpredictability of those renovation costs. Skills and knowledge going into a fix and flip project can help offset some of that risk. It requires expertise in property renovation and that market analysis to determine how much you should spend on those upgrades, and limited potential for long-term income and appreciation. The whole goal of a fix and flip is to get out of it quickly. So number 7, our last one, vacation and short-term rentals. Short-term rentals involve owning and renting out specific vacation properties, such as a mountain cabin, a beach house, or maybe a downtown condo. And you're renting those out on Airbnb or other short-term rental sites to generate higher income. Some of the advantages are the potential for that high income through the short-term rentals. The shorter the term, the higher dollar value you can charge. The flexibility to use that property for your personal vacations. And you still get the tax benefits, such as the deductions for mortgage interest, property taxes, and depreciation, because you own the property. Now, the disadvantages are higher upfront costs and ongoing expenses compared to long-term rentals. it can cost as much as 30 to 40% for property management of short-term. Time-consuming management and maintenance tasks. You've got to think, every time somebody leaves your rental, you're going to have to go in and clean and or manage that property. And then the dependence on the performance of the vacation rental market or tourism industry for that area. You also want to be careful with short-term rentals on the government restrictions. Some areas don't allow for anything less than 1 month, so make sure to check it out before you buy one. So that was a lot, and that was just the tip of the iceberg. There are so many ways that you can start investing in real estate. If you want to learn more, make sure to sign up for our Building an Investment Empire. We host it at our office every second Thursday evening, and we would of course love to see you there because this was just the beginning. If you want to dive deep and you want to make sure to secure your financial future, you want to take ownership of real estate investing.